Can you imagine an institution where over $100 billion changes hands every single day? An institution that holds the retirement savings of over 58% of American households. Yet, if you ask the average person on the street how it actually works, most will tell you it feels like a giant glorified casino. I am talking about the stock market. With recent market swings, interest rate shifts by the Fed, and tech giants adding trillions in value, it's dominating headlines once again. So I thought this would be the perfect time to break down what the stock market actually is, how it was created, and why it plays such a massive role in your everyday life. Why was the stock market created? To understand why the stock market exists, we have to travel back over 400 years, to the year 1602 in Amsterdam. Back then, Dutch merchant ships wanted to sail across the globe to trade in spices like cinnamon and pepper. But building a seaworthy ship, hiring a crew, and funding an expedition was insanely expensive and extremely risky. If a pirate attacked or a storm sank the ship, a single merchant could be completely ruined overnight. So, the Dutch East India Company came up with a revolutionary idea. Why should one rich person take all the risk? Why not allow regular citizens to buy small shares of ownership in the company? If the ship returned packed with spices, every single investor received a cut of the profits based on how many shares they owned. If the ship sank, no single person lost their entire life savings. To trade these paper ownership certificates, they created the world's first stock exchange in Amsterdam. Fast forward to 1792 in New York City. Around 24 stockbrokers gathered under a buttonwood tree on Wall Street and signed an agreement to trade shares in American companies. That very spot under the tree eventually became the New York Stock Exchange. How do stocks work? At its core, a stock isn't just a flashing green or red number on your phone screen. A stock represents real, legal fractional ownership of a real business. Let's take a simple everyday example. Imagine your friend starts a local pizza shop. She needs $100,000 to buy ovens and renovate the space, but she only has $50,000. So she asks you to put in the remaining $50,000. In exchange, she gives you 50% ownership of the business. You now own 50% of the equipment, 50% of the recipe, and 50% of all future profits. If the pizza shop becomes a national chain, your 50% stake might become worth $5 million. If the pizza shop fails and closes down, your stake becomes worth zero. When companies like Apple, Amazon, or Tesla go public through an initial public offering, they are doing the exact same thing, just on a massive global scale. They split ownership into millions of tiny slices called shares and sell them to the public to raise cash for growth. What makes stock prices go up and down? Now comes the big question, why do stock prices fluctuate every second? If truth be told, predicting short-term stock movements requires understanding complex quantitative models, macroeconomic data, and psychological sentiment, which even Wall Street experts often get wrong. But if you want to understand the underlying engine, basic economics is all you need. Supply and demand. Imagine you go to a farmer's market to buy apples. If a drought wipes out 90% of the apple harvest, but everyone still wants apples, the price of the remaining apples skyrockets. Conversely, if there is a massive surplus of apples and nobody wants them, sellers slash prices just to get rid of them. The stock market is identical. If a company reports record revenue, invents a groundbreaking product, or gets favorable news, more people want to buy the stock than sell it. The price goes up. If a company loses money, faces lawsuits, or economic growth slows, more people want to sell. The price drops. The role of Wall Street and the Fed. However, modern stock markets aren't just driven by how well companies perform. They are heavily influenced by central banks, specifically the U.S. Federal Reserve. When the Federal Reserve cuts interest rates, borrowing money becomes cheap for corporations and consumers. Money flows out of low-yielding savings, accounts, and into the stock market looking for higher returns. This creates a bull market, a period where stock prices rise over an extended period. On the flip side, during economic crises like the 1929 Great Depression, the 2008 financial meltdown, or periods of high inflation, confidence shatters. Panic selling sets in, turning into a bear market, where stock values drop 20% or more from recent highs. You might remember 2008, when subprime mortgage defaults wiped out historic investment. Banks like Lehman Brothers almost overnight. Mom and pop investors saw millions erased from their retirement accounts. And who paid the ultimate price? Everyday working people. If all these financial terms feel overwhelming, don't worry, because understanding how to navigate the stock market as a personal investor is much simpler. than trying to time its short-term ups and downs. Investing versus speculating. It is crucial to understand that there are two very different ways people approach the stock market. On one side, you have short-term traders or speculators. They buy individual stocks or options, hoping to flip them in days, hours, or minutes for quick profits. This is high risk. Studies consistently show that over 90% of active day traders lose money over a 5-year period because predicting short-term market noise is nearly impossible. On the other side, you have long-term investors. Their strategy isn't to gamble on individual company stock picks, but to participate in the long-term growth of the overall economy. Instead of trying to guess whether Apple, Microsoft, or Exxon will win next quarter, they buy an index fund, like an S&P 500 index fund. An S&P 500 index fund buys a tiny piece of the 500 largest publicly traded American corporations. When you buy one share of an S&P 500 index fund, you instantly own a slice of corporate America. The power of compound interest. Why do legendary investors like Warren Buffett recommend index funds for everyday Americans? Because historically, over the last 90+ years, despite wars, recessions, pandemics, and inflation, the S&P 500 has delivered an average annual return of roughly 10%. Take a look at what that means in practice through the power of compound interest. If a 25-year-old invests $300 a month into an S&P 500 index fund inside a tax-advantaged retirement account like a Roth, IRA, or 401k, by the time they reach retirement age at 65, they will have contributed around $24,000 out of pocket. But thanks to continuous compounding at that historical 10% average rate, that account could grow to over $1.8 million. You aren't working for the money anymore. Your money is working for you by owning productive businesses. The stock market can certainly feel intimidating, noisy, and volatile in the short term. News channels thrive on sensational headlines to keep you glued to the screen. When markets dip, panic sets in. When markets surge, fear of missing out takes over. But history shows that those who treat the stock market not as a casino for quick wealth, but as a vehicle for long-term ownership and growing companies, tend to come out ahead. What about you? Are you currently invested in the stock market? Or do you prefer holding cash or real estate? Let me know your thoughts in the comments below. If you found this video helpful, hit that like button and subscribe for more educational breakdowns. See you in the next video!